It's a flare in the night sky. The kind of signal that shows up when the polite version of reality can't be maintained anymore. 7% devaluation, 43 in one decision. And alongside that, reports pointed to a parallel market rate above 9 dinars per dollar. That gap isn't a footnote. That gap is the story. Because when the official rate and the real-world price of dollars drift too far apart, the currency isn't just weakening. The entire pricing mechanism for the economy starts to split in two. One price exists on paper. Another price exists in the street, in trade, in invoices, in survival. This is where it gets serious. Not because one country adjusted a number, but because currency. Stress almost never stays politely contained. It spreads through the plumbing, through access to dollars, through settlement rules, through import approvals, through informal fees, and through the widening space between what's announced and what's actually happening. Ask a simple question. What does it take for a central bank to publicly admit that the currency is worth less than it was yesterday? Usually, it's some mix of hard currency inflows weakening, hard currency outflows staying stubborn, and domestic spending demands expanding faster than reserves can support. And that combination isn't rare. It's common, especially in economies where imports are the backbone of daily life. Here's what needs to be understood. A currency isn't only a symbol, a flag, or a political identity. It's a gatekeeper. It's the mechanism that decides how expensive the outside world becomes. Food imports, priced in dollars. Fuel and refined products, priced in dollars. Medicine, equipment, spare parts, machinery, often priced in dollars. Shipping, insurance, trade finance, dollars everywhere. So when dollars become scarce or hard to access through official channels, the currency becomes a pressure valve. If the valve doesn't move smoothly, the system builds a second valve, the parallel market. That's why the spread matters so much. An official rate is the state's rate. It's the rate recognized for certain transactions. Official imports, customs valuations, government accounting, sometimes salaries and subsidies. It's the rate the government wants to be real. A parallel rate is the clearing price that emerges when the official system cannot satisfy real demand, or when access is restricted, slow, politically filtered, or expensive. The parallel rate is what happens when the market is forced to find oxygen on its own. And the spread between them? That spread is the hidden tax. A wide spread means someone is paying more for dollars than the government admits. It means import costs are rising in practice, even if the official chart looks calm. It means inflation pressure is building through imported goods. It means households and businesses start hedging, not out of greed, but out of fear of losing purchasing power. Let that sink in. The moment a parallel market becomes the real market, confidence doesn't disappear all at once. It leaks, quietly, then suddenly. Now zoom out, because this is not only a Libya story, it's a regional story about managed currencies, structural dollar demand, and the fragility of credibility. Dinar isn't one currency. It's a family name across the region. Libya, Iraq, Algeria, Tunisia, Jordan, Kuwait, Bahrain. Some are pegs, some are managed floats, some are more liquid than others, some have deeper reserves, some have stronger institutions. But the physics are the same. If a country can't consistently generate enough foreign exchange, through oil and gas, tourism, remittances, exports, investment, or financing, then something must adjust. If the official system refuses to let price adjust, quantity adjusts instead. Rationing, delays, restrictions, priority lists, informal markups, a widening black market. If the official system lets price adjust, that's devaluation. And devaluation is not just a number, it's a redistribution event. It shifts purchasing power away from wage earners and toward anyone holding hard currency or hard assets. It changes pricing across the economy. It changes behavior. 7% move matters. It announces that the old structure wasn't clearing. Now bring Iraq into the frame, not as a direct copy of Libya, but as another example of how official stability can exist alongside real stress. Official narratives can emphasize stability around a certain level, around 1,300 dinars per dollar, for example. International institutions can reference those levels as the operating baseline, but market snapshots can still show a weaker number at times, around the 1,418 area in some late 2025 references. That difference, even if it comes and goes, is friction. That difference is the cost of access, the cost of compliance, the cost of delays, the cost of uncertainty. Here's the key insight. In managed regimes, the chart is not always the official rate. Sometimes the real chart is the spread. The spread tells the truth about pressure. The spread shows whether the system is clearing. The spread reveals whether controls are working, whether inflows are sufficient, and whether confidence is improving or breaking down. Now consider Algeria, a country where the official exchange rate can look relatively steady on a screen, hovering in a narrow band, while the parallel market can retain influence precisely because access, restrictions, and incentives keep demand alive outside formal channels. A stable-looking official line does not automatically mean stability in the lived economy. It can simply mean pressure is being stored elsewhere. Tunisia is different again, less oil-driven, more dependent on growth, tourism, financing conditions, inflation dynamics, and external balance management. 5%. Those are real stabilizing signals, but they still exist inside a system that must constantly balance external financing needs with domestic conditions. So why put these together? A dollar moment is when the world is reminded that dollars are the settlement currency for a huge share of global trade, credit, and commodities. So when liquidity tightens or confidence falls, the demand for dollars spikes at exactly the wrong time. And the region is uniquely sensitive to this because many economies are import-linked, policy-managed, and heavily exposed to commodity and geopolitical cycles. Oil matters here a lot. When Brent is trading around the $70 area and geopolitical risk rises, the math changes quickly for exporters. Higher oil revenue can strengthen inflows, support reserves, and temporarily relieve FX stress. But there's a catch. If spending expands as fast as revenue, the relief can evaporate. This is the trap. Higher inflows can become higher temptation. And when spending commitments are heavy, subsidies, payrolls, transfers, political obligations, the fiscal engine can run hot even when revenue improves. If governance is fragmented or competing spending centers exist, the fiscal impulse becomes unpredictable, and the FX system pays the bill. Now, add the US dollar itself. In late January, commentary pointed to the dollar index sliding toward multi-year lows, one of the weakest levels in nearly 4 years. On paper, a weaker dollar can ease pressure for some emerging markets. It can loosen financial conditions, support risk appetite, and shift flows. International analysis has discussed how dollar depreciation can transmit easier financial conditions through exchange rates and balance sheets. But in this matters, dollar weakness doesn't automatically fix a structural FX bottleneck. Because a structural bottleneck is about availability, access, and credibility, not just the global price of the dollar. If the constraint is reserves management, enforcement, fragmented governance, or a clogged settlement system, then even in a weaker dollar world, the domestic reality can still be dollar scarcity. That's why Libya's devaluation is so telling. It's a sign the imbalance is not cosmetic. It's a sign the old rate wasn't survivable. Now step into the mechanics more deeply, because surface commentary misses the core. Hard currency supply comes from a handful of channels: oil and gas exports, tourism receipts, worker remittances, non-oil exports, foreign direct investment, external borrowing, and official financing. Hard currency demand is relentless. Food imports, fuel imports, medicine and equipment, capital goods and industrial inputs, debt service, capital outflows, legal and illegal. And the big one that spikes during stress, hedging behavior by households and businesses. When demand outpaces supply, the system must choose how to adjust. If price is controlled, quantity is rationed. If quantity is allowed, price adjusts. Devaluation. If neither is managed well, the parallel market becomes the default. And this is why currency stress often shows up before it becomes a headline. First, the spread widens. Then, access tightens. Then, invoice timing becomes a weapon. Then, price increases leak into daily goods. Then, the official number changes. And everyone acts surprised. But the system was screaming the whole time. Now for the historical rhyme, because this pattern has been seen before. During the 2014-2016 oil downturn, oil revenue compression forced budget adjustments and strained reserves across multiple exporters and nearby economies. The details varied, but the rhyme was consistent. When the primary inflow weakens and spending doesn't adjust fast enough, currency pressure rises, openly or quietly. And March 2020 delivered another universal lesson. Liquidity can disappear in days, spreads can widen violently, policy can override what looked stable the week before. That's why stable until it isn't is the right mindset for managed systems under stress. Now bring technical thinking into it, not in the sense of drawing perfect chart patterns on a thin market, but in the sense of recognizing regimes. A step function move, hold, then reprice, is a regime marker. It suggests the system has transitioned from one band of reality to another. And after a regime shift, systems often do two things. Then they test whether the new normal will be defended. That's why the parallel market level matters so much. The parallel market acts like a stress ceiling. It's where credibility gets tested. It's where pressure concentrates. Now, caution. That kind of thinking destroys people. Here is the bearish case, the case for pressure easing. If the global dollar remains weak, financial conditions can loosen for some emerging markets, making external financing and balance sheet pressures less intense. If oil stays firm or rises, exporters can see improved inflows, which can support reserves and ease pressure. Policy can surprise, enforcement can tighten, financing arrangements can appear, reforms can be implemented and spreads can narrow temporarily. Some economies can show improving macro signals, like narrowing external deficits, decelerating inflation, and interest rate adjustments, which can stabilize expectations. All of that can happen. But here's what those possibilities don't change. When a central bank chooses devaluation as the tool, it usually means the imbalance is structural enough that the old arrangement couldn't clear. A one-time move doesn't automatically fix the problem. Often, it simply resets the starting point. And if the underlying drivers remain, weak confidence, heavy import dependence, fiscal strain, fragmented governance, restricted access to FX, pressure returns. So what does this mean in practical terms? It depends on who is listening. For traders and market observers, the focus is volatility and spreads, not just the headline official rate, the gap between official and real access, the speed of policy announcements, the consistency of enforcement, the rhythm of liquidity. For businesses operating in these environments, the focus is settlement and timing, the ability to pay suppliers, documentation requirements, delays, informal costs, inventory strategy, pricing strategy. Because currency stress hits the business through logistics before it hits the business through headlines. For households and savers inside these systems, the focus is purchasing power, the price of imported essentials, the stability of wages relative to goods, the availability of staples. For outside investors and analysts, the focus is sustainability, fiscal balance under stress, reserve adequacy, social stability under imported inflation, external financing capacity, political coordination. Now move from understanding to actionable intelligence, because the goal is not panic, it's clarity. 3 indicators tell the story early, often earlier than the news. The spread between official and parallel rates. A widening spread means pressure is building. A narrowing spread can mean supply improved, controls tightened, or demand fell, each with different implications. Key commodity prices, especially oil. Oil is a cash flow engine for exporters and a cost driver for importers. When oil swings, the FX math can change fast. Signals around external financing and institutional assessments. When multilateral institutions emphasize fiscal discipline, external balance management, and governance capacity, it often reveals where the real constraint lives. And there's a 4th indicator that matters more than it gets credit for: clarity of fiscal authority. When spending authority is fragmented or contested, the FX system becomes harder to stabilize, because the outflow side of the equation becomes unpredictable. Now, verification matters. Central bank announcements are public. Compare the before and after rates. Track how quickly spreads respond. Watch for new restrictions on imports, settlement, or access to foreign currency. Cross-check credible macro reporting and institutional assessments. Separate facts from interpretations. That discipline is the difference between informed analysis and emotional guessing. And here's the deeper point that makes all of this click. Currency pressure isn't always a morality play. It's often a math problem. Inflows versus outflows. Credibility versus demand. Official narrative versus settlement reality. When that math gets tight, the currency isn't the only thing that moves. Trade patterns shift, subsidy structures change, capital controls tighten or leak, pricing behavior adapts, social behavior adapts. That's why dinar pressure is not just a chart story, it's a lived economy story. Now hold on to 3 takeaways. Simple, but not simplistic. It often signals a structural imbalance being acknowledged, and it tends to carry second order. Effects like imported inflation and ongoing spread dynamics. In managed regimes, the real story is often the spread, not the headline. The gap between official rate and real market access is where pressure accumulates and where the system reveals its true condition. The macro backdrop, oil, the dollar, and external financing, can soften or amplify regional currency stress, but it does not erase structural issues like fiscal discipline and institutional credibility. Full risk disclosure. FX markets, especially under controls and low liquidity, can gap. Spreads can widen without warning. Policy can override charts. Access can change overnight. This is educational analysis, not financial advice. Independent verification matters. Position sizing and personal risk tolerance matter. No outcome is guaranteed. And the core message is this. When a dinar system shows visible pressure, the signal is rarely isolated. It's a reminder that the region's currencies are being stress tested by the same forces at once. Dollar demand, import dependence, fiscal choices, and credibility. Watch the spread. Watch the plumbing. Watch the incentives. Because the biggest surprises in FX almost never arrive as a surprise. They arrive as a pattern, and then a new official number.